Good afternoon, and welcome to our first COL Multi-Asset Investing Summit. I'm Marvin Fausto, President of COL Investment Management. This summit aims to give us a preview of the possible investing landscape next year for different investment instruments. But today, we will be talking about the situation of the Philippine economy and its prospects, and give you a picture of the environment of how it will generally affect our investments. We will be talking to fund managers also later and discuss how it will affect fixed income investments. And then tomorrow, we will talk about the themes for global investing and local stock market. So we will have 2 days to talk about investing. But for today, we will focus on the Philippine growth story. Will yields push higher? So that is our title for today. At this point, allow me to share our latest investor survey to listen to your voice about your investments. I believe this is the only survey out there talking about this, and it is interesting to see how things are changing in the retail investment climate given what is happening here and the world. So let us look at the results. But these are the questions that we asked. How is your financial situation today compared to last year, to 2020? Second, have your investment considerations changed compared to a year ago? Third, what are your primary considerations when choosing investments? And fourth, in the past 6 months, which of the following products have you invested in? And 5, thinking of the next 12 months, which products, markets will you tap to allocate more of your investable funds? Okay, let's look at the results of our retail investor survey. Okay, when we ask you, how is your financial situation today compared to last year? Majority, or 52%, they're looking at it. Their financial situation is improved. About 52% is much better this year. That's good. Next, when we asked you, have your investment considerations changed compared to a year ago? And 67% of you said, yes, they have changed. With everything that's happened, I think your investment considerations now have changed. And we also asked, for the next slide, what are your primary considerations when choosing an investment? And a lot of you, or 50%, are looking at steady growth with medium risk, which is considered the most important by the clients. And the last 2 questions, last but not the least, we asked you, in the past 6 months, which of the following products have you invested in? And also, if you think of the next 12 months, which of the products/markets will you tap to allocate more of your investable funds? And the results are very clear. Majority still invest in the Philippine stocks. However, there are a lot more options now people are considering, like cryptocurrency, REITs, overseas stocks, and even local and global funds. So as you can see, global funds are now starting to increase as well in terms of the options of the retail investors. So we will be talking about that also. This is quite interesting. We will also share these results to you. And let's start now with our program. The Philippine growth story, will yields push higher? To start our event proper now, let me introduce our keynote speaker, Dr. Cielito Habito. He will be talking about his outlook for the Philippine economy entitled Healing the Scars. Dr. Habito is a professor of economics and the director of the Ateneo Center for Economic Research and Development and the chairman of Brain Trust, Inc. He used to be the NEDA chief during the Ramos years in 1992 to 98. And he holds a doctorate degree and Masters of Arts in Economics from Harvard University. Ladies and gentlemen, let us all welcome Dr. Cielito Habito.
Thank you. Thank you so much, Marvin. And it's a pleasure to be here among your many clients to share my own perspectives about where we have been and where we're headed as far as the Philippine economy is concerned. Let me put up my screen and show you in some 36 slides, which I'll go through a fast clip on what exactly seems to be in store for us. Again, I call it healing the scars because indeed they have been a rather scarred economy in this past year. And so we'd like to actually get out of that and move on, hopefully turn over a new page, especially with new leaders next year. So two general questions: where have we been and where are we headed? Let me go right into it. Of course, where have we been? It's been a painful recession. I like to use my trademark PITIC test, meaning Presyo, Trabaho, and Kita, to assess the overall state of the economy. As far as Presyo is concerned, prices have been higher, have been increasing faster this year compared to last year. And the inflation rate has averaged at 4.5% so far, when it was actually just 2.5 to 2.6 in the last 2 years. Trabaho, or jobs, remain unsettled, in fact, and unemployment remains elevated. It's in fact still at about 7 to 9%, when before the pandemic we were already doing 5 or even under 5% already. As far as growth is concerned, kita, or the incomes or output in the economy, we have seen the end of the recession because of the pandemic. In fact, most of us were surprised that the third quarter showed better than expected figures. It was a 7.1% year on year, and actually a healthy quarter on quarter 3.8% as well. Well, if you look at the inflation trajectory we've been having, you can see how we had been higher, in fact, 2 years ago or 3 years ago now. But again, we seem to be on an uptrend, as I already mentioned the numbers. Trabaho, the government is now tracking it month by month, and you can see on the top line how unemployment rate seems to be moving up and down. And this, of course, was a function of the severity of lockdowns that they were imposing. But if you look at the column on the right, the net jobs created from the previous period has been running at about 614,000 on the average in the past year. And that's very inadequate because we get about 1 million new 15-year-olds every year. Even if not all of them enter the labor force, we still have to have more than that 600,000 if we really want to keep afloat in terms of employment rates. But in terms of the kita, or the GDP, we're back to positive numbers after several quarters, in fact, of negative numbers. And by the way, you may notice the color coding in my slides. No? Being an Ateneo professor, good news comes in blue, the bad news comes in the other color. So we can see how we have that 12% in the second quarter and then 7.1% in the third quarter. And in particular, I call attention to the fact that agriculture actually had positive growth even during the worst of the pandemic last year. In fact, the only reason it had negative growth in the first and the last quarters is because of natural calamities. The Taal volcano eruption in the first quarter, and the Ulysses and the Raleigh typhoons in the fourth quarter. And this year so far, also, the reason why agriculture isn't doing too well is the African swine fever. And it's only that, frankly. If not for the African swine fever, agriculture would have grown positively. And anyway, let me show you the general picture of the GDP trajectory. This is the level, not the growth rate that we are tracking here, quarter on quarter, and seasonally adjusted to correct for the seasonal ups and downs that happen regularly every year with each season. If you look at that graph, the one we measured at in the second quarter, which was initially announced at 11.8, but it's now revised to 12%, it's really that gap between the second quarter this year and the second quarter last year, which was the bottom of the worst recession we've had in since 1980s, in fact. So when we look at that, I was pointing out it was not actually good news in the sense that the economy actually shrank in real time from the first quarter during the second quarter. The only reason it had a high positive number was because we were comparing year on year on an abnormally low base that was the previous year's quarter two figure. Anyway, it became really good news in the third quarter when it became a 7.1 year-on-year growth again, from the third quarter last year. And at the same time, also a quarter-on-quarter positive 3.8% growth. So truly, we are out of recession at this point. Back to agriculture, again, I'd like to show you how, if not for these bad negative numbers on livestock, we actually would have had a positive growth in agriculture. In fact, if I take away livestock and also fishery and forestry, so we're looking at agriculture purely, it's going to be a 2.2. So in short, I'd still point out that agriculture is doing quite well in the Philippines, even in the pandemic. Now, industry itself, where manufacturing is the dominant subsector, has again been growing positively, and manufacturing also is now growing significantly year on year. The only bad news as far as industry is concerned is the construction spending, the construction investments, especially and particularly in the corporations. But government construction has been doing double digits because government has had to really catch up on the build program. And even household residential construction has been multiplying, in fact, growing up by double digits. So if we look at manufacturing in general, what I'd like to note is that as of the second quarter of this year, it was already slightly higher than where we were just before the pandemic hit us, meaning the first quarter of 2020. So you can see the comparison in the first graph. But if you look at the cumulative 3 quarters so far, again, we are still below where we were in 2019. So we still have to regain the lost ground completely from manufacturing. In the services sector, it's a mix of weakness and resilience. And the resilience is shown by the financial sector and the information and communication technology sector. Obviously, we were thriving on online business, on what kinds of things that can be done online. Of course, the only other thing that was positive was government services, because it had to step in where the rest of the economy was down. So here you see that everything is now back to positive. That's the good news part of it. And services, again, is the biggest propeller of our economy as of now. If you look at the demand side or the spending side of the economy, which is what creates the demand that stimulates the production, which is now growing again, well, the thing to look at is household consumption is now back to 7%, more than 7% in fact, whereas last year it shrank by as much as 15.3% if you look at the second quarter last year. But now we have again that kind of expansion, and we look at fixed capital formation, which is the other name for investment in general. The only thing that is not doing too well is corporate and farm investments. But if you look at government investment spending, as well as private sector and government spending on durable equipment, including household construction, intellectual property products, again, it's now beginning to grow again at double digits. Now, after you look at all the economic numbers, what still should concern us is the human cost of the economic decline. And this was made worse by the natural calamities I already mentioned early and late last year. In particular, poverty and hunger escalated in 2020. Hunger doubled from the 2019 levels, in fact. And the charts from the social weather stations show that. Poverty was a record high in terms of people who claimed that they were not poor. There was only 16%, meaning 84% of Filipinos consider themselves either borderline poor or outright poor as of November last year. Happily, that has improved. As of June, anyway, the last survey done by SWS, the non-poor are now 23%, so back to more or less normal. And then if you look at hunger on the right side, again, this is where you'll see that the average incidence of hunger, or the percentage of Filipinos who reported that they felt involuntary hunger, had gone up to 21.1% as against 9.3% in 2019. That has improved to about 13.6%. So it's not as high anymore, but still much higher than the 9.3% in 2019. So the problem with this is that increased hunger will elevate the already high rates of severe malnutrition and stunting in young children, which is a long-term problem we have been facing for some time now. It is literally an epidemic because it afflicts more than 10% of the population. Here it's 33.4, it's now down to 28.8, but that means 1 out of every 3 Filipino children, 5 years old and below, is stunted because of severe malnutrition. Now, frankly, it's not the height that's a problem. It's the fact that those children will never reach full brain and physical development, because 90% of brain development happens in a human being before the age 5, before age 5. Beyond age 5, it's only the remaining 10% that you can hope for. So as I said, a stunted child is damaged for life. So think about what 1 out of 3 children right now will be like when they become members of the labor force, let's say 20 years from now. That is a real threat. Now, education is the other thing that took a severe blow, and we all know how remote learning had to be resorted to. And of course, excluded from that were those who could not even get any connectivity because of lack of the gadgets or lack of connectivity to the internet. Even teachers have problems connecting. They even have to go up their roofs, as you can see in one of those photos up there. So these have been the long-term threats to our country coming from the pandemic recession. So where are we headed? Well, there are hopeful signs and persistent hurdles. The hopeful signs, or the good news, is, as I said, the economy has turned to growth mode. The manufacturing growth has in fact turned positive, although again, it's yet to recover fully what it lost in the pandemic. But it has been led by certain sectors like wood and wood products, non-metallic mineral products, and so on. Things that mostly we export, because export trade has rejuvenated. The other hopeful signs include the agricultural sector, as I've already described, and the fact that remittances or overseas workers are back on a sustained growth trend. Actually, last year they were not hit so badly, but obviously there was still a decline. There was a 0.8% decline only for the whole of 2020, which is a lot less than what people had hoped or had expected to actually see. And like I said, imports and exports are back up on a hefty growth. And the fact that imports are growing faster than exports is leading, of course, to the depreciation that we're seeing in the peso. But that's not necessarily bad news, because when imports are growing, that means that producers are stocking up. Actually, the bulk of our imports are inputs to production, either fuel, capital equipment, raw materials, or intermediate products. So when imports are high, we know that that means that there will be increased production in the quarters ahead. The hurdles, or the bad news facing us, is the fact that there was a resurgence of the pandemic. Although again, the latest hopeful sign is it seems to be abating. And of course, cross fingers, because there's this new Omicron variant that may yet again lead to an upsurge. And we all pray it does not. But obviously our challenge had been to roll out that vaccine as speedily as we could. And right now it has been catching up, I think. But now people are talking about a third booster shot. And so that is where we have to also do much quicker action. The second hurdle has to do with confidence itself, coming from that pandemic experience. And unfortunately, the latest surveys of social weather stations indicate that Filipinos are even more afraid of COVID-19 than ever. In fact, I took a glimpse of the Bangko Sentral Business Expectation Survey yesterday and noted that business confidence is actually down for this third quarter, although it looks higher for the fourth quarter onwards. So if we look at the third hurdle, this is a more long-term problem we've been having for years now. The fact that we cannot attract enough foreign direct investments. We are the bottom dweller as far as comparable ASEAN countries are concerned in attracting foreign direct investments. In fact, it has been going down in the past 4 years. And of course, the last year, 2020, is not surprising because there was a general decline worldwide. But even before that, we were actually sliding downhill as far as attracting FDI is concerned. The fourth hurdle is the fact that businesses are closing, both large and small. And here we have a lot of anecdotal evidence. Well, this photograph on the left is a picture of business licenses being retired in the Parañaque City Hall, taken by a colleague of mine in Ateneo, who also went there to close his small business. And what his sub story is that he even had to shell out 10,000 pesos just to close his business. It turned out he had some outstanding taxes to pay, and there were some closure fees that had to be paid as well. So in short, it's going to be harder to actually pick up again once businesses have decided to close entirely, not just lay low. No? And the fifth hurdle I'd like to talk about simply is the threat of this continuing inflation. Sooner or later, even though this is a supply-induced inflation, the problem is Bangko Sentral, whose mandate is to manage inflation, may sooner or later have to be forced to use monetary policy and tighten up on money and raise interest rates. We all know, I think, that right now they're still holding back. They're trying to hold back as much as possible because they don't want to choke this nascent recovery with higher interest rates. So moving forward, there's two wheels that I think will propel our economy. The main ones are the agriculture and agribusiness sector and the digital economy. Agriculture, for very good reasons. It's proven its resilience, as I've already shown you. If not for uncontrollable circumstances like calamities and of course now the swine pandemic, it would have been growing positively all throughout. It's also present all across the country, and so it will have a more geographically inclusive benefit if agriculture is growing. And we can see that here in these charts that show us the regional contributions in each of the three major sectors of the economy. Look at how services is heavily skewed towards Metro Manila. Industry is heavily skewed towards three regions alone: Metro Manila, Region 4A or Calabar Zone, and Central Luzon or Region 3. But look how more evenly spread it is across the regions. And therefore, it's going to be a much more geographically inclusive growth if agriculture is the source of our growth. It is also strongly interlinked with the rest of the economy, both backward and forward, both as a source of inputs for other industries and both as a buyer of the products of other industries as inputs to agricultural production, apart from being highly labor intensive. Here you can see how agriculture is the second largest producer of jobs in the economy. And those other arrows point to where it is also closely linked. And therefore, those linkages and the job generation is saying that agriculture can help drive recovery in the other key industries that are closely linked to it. And lastly, agriculture and the regional economies are the key to recovery from the recession because that is where it's safest to reopen. In the end, what happens is that all the areas which are COVID infected are the same areas where the GDP contribution and the jobs contribution is the highest. But you can't reopen there as quickly as you can, as in the countryside. So now, really, the hope is in the countryside where agriculture is a primary livelihood. Now, the other wheel that I talk about for accelerated recovery is the overall digital economy. And this is because the new normal is asking us to do everything online. And I don't need to elaborate too much on that. Even the fact that we're meeting online now instead of a physical or face-to-face forum is already a testament to that. It's interesting that this also complements agriculture and agribusiness because agriculture and agribusiness are now being enabled by digital technologies. And a lot of young people are getting interested in farming again, mainly because of the application of digital technologies, all the way from finance, crowdsourcing financing for farmers. I've seen a couple of young people do this very actively, onto the production itself, where drones and other sophisticated technologies are now being used for actual farm production, onto the value chain and marketing, where digital apps like Uber-style applications can be used to connect farmers directly to their buyers. All of this requires substantial investments in upgraded connectivity, still a remaining challenge, and a better logistics system, because a lot of our buying now is done through these online platforms, which requires a lot more of these motorcycle riding men on J&T Express and Lala Move and whatever else. And that is the challenge because we have to bring that all the way to the countryside. The outlook for my PTIC test is inflation at 4 to 5%. The latest projection from the government is that it will probably be 4.3% average for the year. That means they expect it to be down to the upper 3% in the last couple of months. Jobs will be where we are right now. It's going to take a little while more to get back to where we were at 5% already. And GDP growth, the government's revised 4 to 5% happens. In fact, if you look at the projection on GDP quarter to quarter, again, this was the 12% that was measured in the second quarter. This is the 7.1% measured in the third quarter. And based on three scenarios I've drawn, an optimistic, a medium, and a pessimistic scenario. If you look at the medium scenario, it's probably going to be about a 4.5% in the fourth quarter and a full year, therefore, of 4.5% as well. For 2022, I'd expect inflation rate to employment rate probably again 7 to 8%. There's still going to be sluggish job recovery, but our GDP growth might be boosted to 5.5 to 6.5. And a very important reason for that is the election stimulus. On the average, over the past 20 years, election years gave us more than 1 percentage point additional GDP growth. And we expect that to happen again. I can elaborate on that later on if you like. But the job ahead of whoever will become the next president is really to speed up infrastructure buildup, ease the investment restrictions still impeding those foreign direct investments, reduce regulatory burdens, which are part of that impediment, and of course, eradicate graft and corruption. To make it more inclusive, we have to have much more attention given to MSME, the small businesses, to pick up and grow again. Stamp out the hunger and malnutrition, which are long-term threats right now, and therefore hike investments in health and education. So in closing, I just want to say economic recovery now appears to be underway, but how fast or how slowly it unfolds will hinge on how we bring the COVID-19s down. So health recovery remains top priority. Thank you very much, and I'll be happy to answer questions.
Thank you for that. Thank you for that, Dr. Habito. Wow. Well, very comprehensive presentation, sir. But you see, I've observed that a lot of people are still poor, and we still have a lot of things to hurdle. But thank you for saying that we are already out of recession and everything's back to positive. And it appears that things are going to be better next year. I also like what you pointed out, the two wheels that will propel our economy, agriculture, digital economy as major drivers. Thank you very much. I have a few questions, if you don't mind, sir.
Yes, go ahead.
Yes. You presented a GDP growth rate next year of about 5.5 to 6.5%. Is that only because of elections? Or can we expect more growth due to the reopening of the economy?
Well, frankly, the elections will be a boost, definitely. And I have to admit that this projection is still somewhat conservative, mainly because, again, in this past year, we have seen the need to be conservative, especially because our government did not handle the pandemic too well. I think it's well admitted now and well acknowledged. We started this past year with people actually projecting that we would do 6 to 7%. And of course, where did we end up? Well, it's going to be more between 4 to 5% now. And I think, frankly, we in the Ateneo Center for Economic Research and Development had already been projecting 3 to 4% for this year since January. And part of it was foreseeing that the government was not going to be handling this pandemic too well. So unless the new government that gets voted in May really does a tremendously better job, then I think the 5.5 to 6.5 would probably be a more prudent projection. But I would love to be wrong on that and wrong on the low side.
I hope you're wrong, sir, because you're speaking about this turnover. Given what you have seen so far, my question is, at what state would you say we are in when the present administration finally hands over the country to the next administration? Are we in a precarious state? Are we in an okay state, or are we in a good shape?
Well, maybe the phrase I'd use is we're muddling through right now, and we'll probably be muddling through until that change over. The good news, I guess, contrary to what a lot of people are worried about, is that I don't think our fiscal status, especially the debt situation, is really something that people should overly worry about. First of all, most other countries, if not all other countries, are also heavily in debt as a result of the pandemic. And the fact is, we came into it much stronger than many other countries. Our debt to GDP ratio had been at a low 39% before the pandemic started. And the latest report from the government is that we have hit 60%, which is the threshold people usually consider before it becomes a bit worrisome. But we're there, and our financial authorities, our fiscal authorities in the Department of Finance are taking care not to raise it further than that. And so that will keep us a bit more, resilient as we go forward because they are managing the finances of the country very well. So I don't think we should worry about that. And, I intend to write an article on the national debt soon just to explain to people that it's not like family debt where you really have to repay it at some point, because national debt is something you can keep rolling over and over and over. And for as long as the debt stock does not grow faster than the GDP does, then we're okay. So in that sense, we simply have to manage it so that the GDP growth will outstrip the growth of the debt itself.
I hope you're right, sir. I hope you're right, because people are getting worried that we are, the last time I saw is 63% debt to GDP, and people are a little bit worried about that, no? And you're saying that there's nothing to worry about at this point.
Well, let me say that we were at 75% at the earlier part of this century. And that's why we had to raise VAT to 12% in 2006 or 2007. So again, we're nowhere near that right now. And I think Secretary Dominguez is making sure that by the time they pass over the government to the next administration, it would not be anywhere near that.
You spoke about Secretary Dominguez, and we understand he came up with a lot of reforms, more particularly the CREATE bill. I think you mentioned that, but is there really a multiplier effect on that? Like, diba, binaba na sir yung taxes, diba? So, but we don't really see that eh. Parang nagiging savings lang yun eh. Is there a multiplier that can jump our GDP to higher than 6?
Well, first of all, that tax reform, particularly the last-minute change of making the reduction in corporate income tax immediate rather than phased in as originally planned, was meant more to attract more foreign direct investment. And whether or not that is working is not too clear right now. But the other important reform was also the ability of the government now to customize incentives so that we can run after big ticket items, the way that our neighbors have been strategically doing, frankly. So the CREATE law creates more flexibility in the way that we can grant fiscal incentives while removing the unnecessary or shall we say superfluous incentives that have been there in the past. But more importantly, if you look at multiplier effect, the thing to do, and I'd like to tell this to all my audiences, we ourselves have to be the ones to maximize that multiplier effect, that by consciously buying local as much as we could. The moment you buy imported goods, then you are making the multiplier effect happen abroad where you bought it. That's why when we were told that a presidential jet plane was going to be paid for last year, everybody came up in arms because the billions that would be spent for that, the multiplier effect would happen in the United States rather than in the Philippines. So please, let's all think buy local, and not only local meaning domestic goods, but local from your own communities. Help your own local community economy by buying goods made in your own localities.
Yan, buy local. So guys, yung mga nag-online shopping dyan, make sure yung binibili nyo, it's not Amazon, it's from local suppliers, diba, sir? It's very interesting, sir. No? Looking beyond 2022 kaya, sir, can we really look, regardless of who wins, no? Are we going to have like post-pandemic period? What kind of trajectory can we conservatively expect kaya?
Well, as you probably understand, it's so hard to predict what the economy would be like unless we're more clear about the next leadership. And I'll tell you why. I mean, in between 2010 and 2016, there was a very clear uptrend. Even, well, first of all, the investment growth was double-digit almost all throughout until, again, 2016. 2017, in terms of foreign investment, that's when it peaked because there was still a spillover from the confidence in the governance in the previous 6-year period. But from then on, it went downhill. So, I can talk about all the other indicators, which all were improving. Manufacturing growth was faster than the overall GDP growth, in fact, 7 to 8% at the time. But now, we saw that going back down again. And let's be frank about it. It's the governance that has led to this lack of confidence in the economy. So we need a new government that will inspire that kind of confidence, that will really allow us to resume, hopefully, the momentum that had already been built since 2010. In fact, we were headed for a real higher plane of growth at the time, simply because the confidence of the investors, both domestic and foreign, was very high. Unfortunately, that seems to have been shot in the past several years for all different reasons. So, without being clear on what the new set of leaders and therefore government will be looking like, It's going to be a murky crystal ball to be looking at.
So confidence is the key, sir. So we'll surely hope for that.